Have you ever wondered how the stock market works? This question has crossed the minds of many, sparking curiosity and intrigue. You see, the stock market is not just some abstract entity that only affects the wealthy or those in finance. It's a dynamic, ever-changing organism that plays a vital role in our economy and influences our everyday lives. Imagine the stock market as a bustling marketplace where buyers and sellers come together to trade shares of publicly traded companies. It's a place where fortunes are made, dreams are realized, and sometimes where hopes are dashed. Understanding the stock market is like learning a new language. It might seem complicated at first, but once you grasp the basics, you'll see it's not as intimidating as it might seem. It's a fascinating world, full of opportunities and risks. By the end of this video, you will have a clearer understanding of the stock market and how it operates. So, what exactly is the stock market? Great question. Imagine a bustling marketplace, but instead of buying and selling fruits or clothes, people are trading shares of companies. This marketplace is called the stock market, a fascinating platform where buyers and sellers converge to trade company shares. These shares, also known as stocks, represent ownership in a company. So when you buy a company's stock, you're essentially becoming a part owner of that company. Now, isn't that an exciting thought? Owning a piece of a company without having to run it. But why do people buy these shares? Simple, to make money. The fundamental principle of the stock market is buying low and selling high. You purchase shares when the prices are low, hang on to them as the company grows and succeeds, and then sell them when the prices are high. Of course, this is easier said than done. The stock market is influenced by a myriad of factors, from economic conditions and political events to company performance and investor sentiment. This makes the prices of stocks constantly fluctuate. Despite this, many people are drawn to the stock market because of the potential for profit. When you buy a share at a low price and sell it at a higher price, the difference is your profit. Additionally, some companies pay out dividends, which are a portion of the company's earnings distributed to shareholders. However, it's not all about profits. The stock market also plays a crucial role in the economy. It allows companies to raise capital for expansion and innovation, contributing to economic growth and job creation. It's important to note that while the stock market can be a profitable venture, it can also be risky. The prices of stocks can go down as well as up, and there's always the possibility of losing money. That's why it's essential to do your research and understand the market before diving in. In essence, the stock market is a marketplace for trading company shares and making profits. But it's also much more than that. It's a place of opportunity, risk, and economic growth. Now that you know what the stock market is, who are the main players in this market? First up, we have investors. These are individuals or institutions who buy shares in companies with the hope that the value of these shares will increase over time. They're essentially placing bets on the future success of these companies. Investors can range from everyday people looking to grow their savings to large institutions like pension funds and insurance companies. Next, we have brokers. Brokers act as intermediaries between buyers and sellers in the stock market. They execute trades on behalf of investors. In return, they earn a commission on each transaction. Brokers can be individuals or companies, and they play a key role in ensuring that the market operates smoothly and efficiently. Finally, let's talk about the companies themselves. These are the entities that issue shares to raise capital. When a company decides it wants to go public, it will issue shares through a process known as an initial public offering, or IPO for short. Once these shares are issued, they can be bought and sold on the stock market. The company's performance directly affects the value of its shares. If a company is doing well, the value of its shares will likely go up. If it's struggling, the value of its shares could go down. So to sum it up, investors provide the capital, brokers facilitate the transactions, and companies offer the investment opportunities. Each player has a unique role, and without one, the market wouldn't function as we know it. Now, it's important to remember that the stock market isn't a zero-sum game. It's not about one player winning at the expense of another. Instead, the stock market is a place where investors, brokers, and companies can all benefit. When a company performs well, its share price increases, benefiting its investors. Brokers earn commissions on increased trading activity, and companies gain access to capital that can be used to grow their businesses. These players, with their diverse roles, keep the market vibrant and dynamic. Ever heard of the term stock exchange and wondered what it means? Well, let's demystify it for you. Picture a bustling marketplace, but instead of fruits, vegetables, or other goods, the commodities of interest are stocks. This, in essence, is a stock exchange. Places like the New York Stock Exchange or the NASDAQ are examples of this. They provide a regulated platform where buyers and sellers can trade shares of public companies. It's like a giant networking event where everyone is looking to make a deal. These exchanges are governed by rules and regulations to ensure fairness and transparency. They monitor the trading activity, listing qualifications, and other aspects to maintain a level playing field. So, whether it's a multi-billion-dollar corporation or a startup company, they all rely on the stock exchange to provide a marketplace for their shares. Stock exchanges are the heart of the stock market, facilitating all the buying and selling of shares. A pressing question for many is, how are stock prices determined? It's a complex process, but let's break it down to a digestible level. Firstly, we have the company performance. The better a company is perceived to do in terms of revenue, profits, and growth prospects, the higher its stock price tends to be. This is because investors are willing to pay more for a share of a company that they believe will make them more money in the future. Then we have economic indicators. These are broad measures of the economy's health, such as GDP growth, inflation rates, and unemployment levels. When the economy is doing well, people are more willing to invest in stocks, pushing up prices. Conversely, when the economy is in a slump, investors may shy away from stocks, causing prices to drop. Next, let's talk about interest rates. These rates set by central banks impact the cost of borrowing money. When interest rates are low, companies can borrow more cheaply, potentially boosting their profits and making their stocks more attractive. Higher interest rates, on the other hand, can make stocks less appealing compared to other investments. And then there's market sentiment. This is the overall attitude of investors toward a particular stock or the stock market in general. It's highly subjective and can be influenced by news, rumors, and even emotions. When investors are optimistic, they're likely to buy stocks, which can drive up prices. But if they're pessimistic, they might sell stocks, pushing prices down. Last but not least, supply and demand play a crucial role. If more people want to buy a stock, demand, then sell it, supply, the price goes up. If more people want to sell a stock than buy it, the price goes down. Remember, stock prices are influenced by a host of factors and can change rapidly. This means investing in stocks requires careful thought, research, and a tolerance for risk. With great potential for profit comes great risk. Let's discuss the risks and rewards of the stock market. The stock market is a double-edged sword. On one side, it's a place where dreams can come true, where small investments can transform into considerable fortunes. On the other side, it's a place where fortunes can disappear as quickly as they were made. This is the inherent risk and reward system that defines the stock market. Let's first talk about the rewards. The stock market offers the potential for significant financial gain. By investing in stocks, you're buying a small piece of a company. If that company does well, you stand to profit. The better the company performs, the more your investment is worth. Over time, these profits can compound, leading to even greater earnings. This is the allure of the stock market, the possibility of turning a modest sum into a hefty nest egg. But as we all know, there's no such thing as a free lunch. With the potential for profit comes the potential for loss. This is the risk side of the equation. Stocks can lose value as well as gain it. If the company you've invested in performs poorly, the value of your investment will decrease. In the worst-case scenario, a company can go bankrupt and its stock can become worthless. This is why it's essential to diversify your portfolio, spreading your risk across various sectors and companies. So how can you navigate these turbulent waters? The key is research and understanding. Before you invest, research the company, its performance, its industry, and its competitors. Understand the market conditions and economic factors that could affect your investment. The more informed you are, the better decisions you can make. And remember, investing in the stock market is not a get-rich-quick scheme. It requires patience, discipline, and a willingness to ride out the market's ups and downs. While the stock market does offer potential for profit, it's crucial to understand the risks involved. So we've taken a whirlwind tour of the stock market. Let's recap what we've learned. We started off by understanding the basics of the stock market, a bustling marketplace for buying and selling shares. We then familiarized ourselves with the key players in this market, the investors, brokers, and companies. Each one plays a pivotal role in the dynamics of the stock market. We also delved into the workings of the stock exchange, a platform where transactions happen. We learned how stock prices are determined, a complex process influenced by supply and demand, company performance, and market sentiment. And finally, we touched on the risks and rewards of investing in the stock market. The potential for high returns comes with the risk of substantial losses. And there you have it, a beginner's guide to understanding the stock market. Remember, knowledge is power, especially when it comes to investing.